Welcome, everybody. This is the 79th episode of the Hashtag Investors Podcast. I am your host, Scott Bauer. Today, we got Yonah Weiss with us. And those of you that have been loyal listeners of the show will notice a different background here for me. This is the first episode in a new office, hence why all of the empty space in the back. But really excited to be here today with Yonah. Yonah, how are you?
I am doing wonderfully. I appreciate you having me on.
Yeah, man. Glad to have you here. A little bit about Yonah, just to kind of bring everybody up to speed here. He's a powerhouse when it comes to property owners' tax savings, which we're certainly going to get into. He's the business director at Madison SPECS, which is a national cost segregation leader, and has assisted clients in saving tens of millions of dollars on taxes through cost segregation. He has a background in teaching and a passion for real estate and helping others. So those are great traits to bring to the show. And Yonah, thanks for being here, man.
Yeah, I'm waiting for when the next bio will be able to turn that to hundreds of millions. Like, time goes on. We keep helping people every single day. Eventually it's going to be from tens of millions to hundreds. But, our company definitely has, but myself personally not. We've done, helped over close to $4 billion in tax savings for people. But yeah, I'm doing incredibly today. It's a great week. I'm happy to be on with you and happy to, dig deep right into this awesome subject.
Yeah, man. Looking forward to doing that. But why don't we give the listeners a little bit more about your background, kind of how you got into the real estate space or how you got into the cost segregation space or kind of all of the above. Give the listeners a bit about your background.
Sure. It's an interesting story how I got into the cost segregation space, but I'll start with it kind of led from the fact that I started an interest in real estate about 5 years ago. And I, partnered up with a friend of mine who was working for a small boutique commercial financing company. So doing commercial mortgages, hard money lending, and these type of things for individual high net worth clients. And we became, very good friends through that. And we eventually ended up doing 5 fix and flips together. The two of us. I got my real estate broker's license. He really wanted to learn every aspect of the real estate business. He went off on his own and started managing his own fund, a mortgage company. And, he actually introduced me to the company that I work for now, Madison SPECS, Madison Commercial Real Estate Services, and it just kind of was incredible. I would say coincidence, but I don't really believe in coincidences. I believe it was more kind of orchestrated that way, that he had met someone, at some random restaurant that he had never been to in his life before, and the person was from a different country, and they met on that day, and he's like, "Hey, you just got a new job. You should speak to Yonah." And it just, one thing led to another, and that's how I got to Madison. And it's incredible.
You were in the right place at the right time, and I think that it's so powerful in the space that we're in, the connections that you build with people, right? Because that opens doors to you that you would not otherwise have, and so that's super powerful. And thanks for sharing that. And that was just 5 years ago, you said. So that's 2019. So that was not that long ago. I mean, you're in the
not very long ago.
2014 timeframe or so when you got into it. So where you did a couple of fix and flips, you can't go from a couple of fix and flips to where you're at now, right? I mean, so there's a lot of leeway in there, right?
Yeah, no, I have a real passion, a thirst for knowledge, and my background is in teaching, and so I naturally, learn things very quickly and want to teach others about it, and it kind of was a natural fit for me to do what I'm doing now within Madison SPECS, which is helping people with cost segregation, but the most difficult thing for people to wrap their heads around is just, what is this all about? Like, the name throws people off, let alone the subject matter. And taxes in general, people hear taxes and they're like cringe, and like, that's for my accountant. Like, no, these are things that everyone needs to know about, especially who are in real estate investing. You want to be proactive about your financial situation. And I myself was kind of moved by that passion of helping people save taxes, and like, that's really changed a lot of people's lives, and I've seen single-handedly how that has just accelerated people's businesses and careers. And so I'm now following in those footsteps myself, and hopefully getting involved in the multifamily investing space myself.
So I think it's important for all of the listeners listening to this podcast now that are real estate investors or interested in real estate, some sort of, let's define what is cost segregation and how does that relate to taxes?
Cost segregation, weird name, right? It used to be called, it's a tax deduction based on depreciation. And it used to be called component depreciation, which makes a lot more sense because what we're doing is we are, instead of depreciating the entire building, meaning writing off the value of the entire building over a certain number of years, we are there's a word for that, compartmentalizing or, segregating out those costs of the value of the building into different assets, okay, into different asset lives. So depreciation in general is a great tool to use, a tax deduction, but people are confused that depreciation means it's going down in value. No, my property, I want it to go up in value. I don't want it to go down in value. Depreciation is like a hypothetical tax deduction that the IRS created to give you benefits because you bought a property, give you this tax benefit that now allows you to write off as a tax write-off the entire value of that property. And for commercial properties, it's over a 39-year span. And for residential and multifamily, which also fits in residential, is over a 27.5-year span. But that's a long time to wait, right? To write off the entire value of the building, $1 million building, right? And writing that off, every year for 39 years, 27 years, $30,000 a year. It's not a lot. There's a way, and this is what cost segregation is, to reallocate those costs, front load a large portion of those deductions to the earlier years of ownership when it really matters the most, when you're active and you want the cash flow. And that's what we're doing.
Now, I have to bring this up because it's a major part of it. Trump's tax laws have a major impact on what cost segregation can do for you today that they couldn't do for you 5 years ago, right?
Correct.
And this was a big learning benefit. Matter of fact, during tax season of last year, I spent a lot of time reading about the tax law and really what the tax law was written for. And really, it was written, if you read the entire length of the tax law, it tells you every reason why you could save money on taxes, right? However, that's not what people think. They think that Uncle Sam is out there to try and take their money. Well, that's not really the case. They just don't understand how the rules are played, right? If you go in to play a sport and you don't know the rules, you're probably going to lose. But if you know the rules, then you know how to win, right?
Exactly.
So let's talk about, is there a specific asset class? Those investors listening to this might be in single family fix and flip. They might be wholesalers. They might be, have a single family portfolio, multifamily. What asset class is the best for cost segregation?
So the bigger the property, the better. And because depreciation is based on the purchase price of that property. So my rule of thumb is usually any property purchased for over $1 million, and it doesn't really matter what the asset class is. I will share with you in a moment, there are certain that have more benefit than others, but any property purchased for $1 million is going to have significant benefit, that it's almost like a no-brainer to do the cost segregation, or at the very least to get a free estimate, which our company provides. Many companies provide that, so you can have the educated kind of decision and see what would my tax situation look like with regular depreciation versus if I did it accelerated through cost segregation. But even if it's $500,000, it still may make sense, because commercial properties, what we're doing is we're reallocating, like I mentioned before, stuff inside the building, personal property that depreciates over 5 years. So instead of waiting 27 years, we can get a whole chunk of that, let's say 20% of that value. So 20% of $1 million is $200,000 of extra depreciation deductions potentially for those first 5 years. So that's, not each year, but over the course of 5 years. So it's really going to be most beneficial for properties, not necessarily of the asset class, but more of the purchase price.
So let's dumb that down even a little bit more. People, you mentioned earlier in the call here that people think, depreciation, I don't want my value going down, I want it going up. So let's correct that for them. And I'll let you do that. It's because it's actually quite the opposite of that, right?
Correct. So depreciation, again, I mentioned it's like a hypothetical deduction. The IRS says, and I'll prove it to you, even if you buy a building that was built in 1925, the day that you buy it, that establishes what your depreciation value is. It's the purchase price minus the land value, and land value is always going to be somewhere between 10, 15, 20%, depending on the location. But that's going to be your basis. Say you buy a building for $1 million, right? And it was built in 1925. It doesn't matter. You start depreciation, those deductions, that write-off of the entire value from day one when you buy it. And when you go ahead and sell that property 5 years from now, right, for $10 million, the guy who buys it from you for $10 million starts over the depreciation deductions from day one for $10 million deduction now. So it has nothing to do with, very little to do that the property is going down in value. It just has to do with the concept that things do go down in value. And so therefore you can have the benefit of that concept as if it were actually going down in value.
So the clock starts over every time it changes hands. So,
Correct.
Right? You buy a property, you own it for 5 years, then you sell it to me on day one. It's day one for me when I buy it, which is beautiful, right? Because otherwise it would be totally different. I don't know how that would make any sense, right?
Right, which is different. I will mention that when it comes to banks, and when banks are appraising a property, they actually use like the useful life, and they'll use the same terminology, but it means something entirely different. So it can be confusing, okay? They'll use the terminology. They'll say, well, this roof has a 10-year useful life, right? The fence has a 15-year useful life, and you've owned, it was, built 12 years ago. So therefore the value of that fence, and they're appraising the property based on the values, the value of that fence is, X, which is, a lot less than what it was when it was placed in service. It was originally built. Not so with depreciation. It actually starts over from new when it changes hands.
Which is, it's so great. And actually last year was the first year that I performed a cost segregation on my portfolio, and it was really pretty astonishing the type of tax savings that I got out of it, right? And I'm a limited partner in a large multifamily, but that's not the majority of where I got my cost savings. The cost segregation savings. It was actually from the small multifamily that I own here in Phoenix and the other single family houses. Yeah. Which was pretty cool. Let's talk about the flip side. Why is it a negative? How can we flip this as being a negative for somebody? Because let's be honest, nothing in this world is free, and everything comes with a cost. Absolutely.
So, right. The IRS, as soon as you start thinking the IRS is your best friend and doing all these great things for you, don't be confused, right? It's not true. To an extent, they're giving these benefits. But you're right. Absolutely right, Scott. There are downsides to it, and I'm glad you brought it up. So a few downsides to cost segregation. Okay, number one, what we're doing is we are accelerating depreciation. We're not creating new deductions out of thin air. What we're doing is we're front-loading a portion of that depreciation to the early years. Now, after you've used that depreciation, especially if you use what's called bonus depreciation, which is taking a huge boatload of that in the first year and front-loading all that to the first year, then after that, it starts to reverse itself. Okay, the depreciation deductions, what you would have had you done straight line, what's called straight line depreciation, the same amount every single year for 27 years. Instead, you are front loading a portion, let's say 20%. So the rest of the 80% is going to be spread over the following 22 years, right? So it's going to be less. So that's number one. You are front loading a portion. Afterwards, you're going to have less depreciation deductions. So for someone who's buying one property, and that's it, okay? They're buying one property, they're planning on holding it for the rest of their lives. It's probably not a good idea to do cost segregation because they may want to plan their taxes out a little more evenly so they're going to get an equal deduction every single year. It's much more, financially sound to budget accordingly. However, if you're planning on buying multiple properties, you're planning on scaling up, this is an incredible tool, cost segregation, to increase your cash flow because reducing your taxes means the money you make, it's your money, right? You made the money. So the money you make, you're keeping.
Right.
there's no law that you have to pay taxes. There's a law that you have to pay taxes if you are required to pay taxes. But if legally you don't have any tax liability because you have so many deductions, then your money you make, it's your money, you keep it.
And so I just want to super dumb this down for all the, for some listeners out there that may not know. If you have $100,000 in income that you make per year, but you have $50,000 in deductions, then that means that the IRS looks at you as although you only made $50,000 in that year, greatly reducing the amount of taxable income that you have. Exactly. Therefore, that's why this is such a beautiful thing, because we all want to keep the money that we make. Nobody wants to write Uncle Sam a check, but the reality is we have to. So how do we play within the rules to be able to do that the right way?
Absolutely. Absolutely right. Perfect. So I'm going to touch on the second thing because there are more than one, kind of downside or dark side to this. So the one thing we mentioned is that, we're utilizing the time value of money, right? We're using our money in the early years and taking benefit from that, of the cash flow, as opposed to just spreading it out. And it's your money again, so you can keep it as long as you can, right? But the second side of this is actually when you go to sell a property. When you sell a property, there is a tax, besides for capital gains tax. If you make a profit on the sale of a property, you have to pay capital gains tax, which is, depending on your tax bracket, could be anywhere between 10, even 0, but it can be 10 and 25%, or so 20% tax, capital gains tax. But there's another tax when you sell a property. It's called depreciation recapture tax. And that means that not that you pay back the depreciation, but it means that now you're taxed on the amount of depreciation that you took. Okay? So now if we're taking extra depreciation up front, that means we're actually going to pay tax on the back end on the sale when we sell the property. We're going to pay. Now, that may sound like really scary. Like, why would I want to do that? Right? And it is. I mean, you definitely need to take that into consideration, right? You have to have an exit strategy. You should know more or less how long you're planning on holding the property, and should discuss with your tax advisor, what's my, long-term plan over here. If the long-term plan is to continue buying properties, then that value of the cash that you have in your hand is probably most valuable, because by paying the taxes today, you're probably paying a high tax rate. Right? 39% maybe even more, depending on which state you're in, right? To combine the federal and state, right? But if you're paying at the depreciation recapture tax is capped at 25%. So anyways, there's a spread between what you would have paid, up front if you pay taxes today versus what you will eventually perhaps have to pay later upon the sale of the property.
So like, for an example, if you do it within the first year, maybe you pay a 40% capital gains tax in year one because it's short-term capital gain.
Short-term. Correct.
You wait for a year to sell it. Now you went from 40% in capital gains down to 25. So you just save yourself a lot.
Yeah. And actually depreciation, I should mention this, depreciation really is not for flipping, okay? If you're flipping, you're buying and selling a property in the same year and your intention was to do so, then you don't take depreciation deductions on that property.
Right.
And obviously bonus depreciation goes out the window as well. But if you are holding a property for more than a year, then, it may be beneficial. But I like to say usually at least 2 years, because it gives you, a longer spread of that cash flow, of that time value of money.
So what is the time frame when you say that there's, you accelerate the depreciation on the assets? What is the time frame? How many years do you get because do you front load it all in year one, or is it for 1 year, first year, second year, third year, fourth year, fifth year, and then there's no more really depreciation because you front loaded it those first 5 years, or does it change?
Right. So what we're doing is we're front loading a portion of the depreciation. Like I mentioned before, cost segregation. What the engineer, and I should have mentioned at the beginning, you need an engineer to actually do this. Right? It's not something you can do on your own. You need, qualified someone who has, training in the tax code and in engineering to come and show how the property is broken down into different assets. So you have the stuff that depreciates over 5 years, and that includes personal property, stuff like, appliances, furniture, cabinetry, carpeting, fixtures, even stuff like millwork or, different types of special purpose electric or special purpose plumbing, a lot of different things. in there, all that depreciates over 5 years. So what we're doing is we're front loading, let's say 20% as a round number of the entire basis, the entire property of that, let's say $1 million property. So 20% of that is $200,000, right? We're front loading that $200,000 to spread over the first 5 years. So we're getting extra deductions of extra, $200,000 over 5 years, extra $40,000 each year for those first 5 years. And that's basically how it works. Unless you choose bonus depreciation, which can take that entire $200,000 in year number 1.
So let me run this by you to see if
go ahead.
it's a good plan. So I buy a property, I fix it up, I increase the value of the property extensively, and I could sell it, but instead I decide I'm just going to refinance it, take the majority of the cash out, and continue to and then use that cash I took out to go buy another property, but then I still have ownership in the property. Is that a good idea? So one, you would not have the recapture, right? You don't have, or do you recapture that?
No, not at all. None whatsoever.
So then, is that a good strategy? Would that be a good way to go for somebody?
That's an incredibly good strategy for more than one reason. Number one, like you mentioned, the recapture tax of the depreciation only happens upon sale. Okay? But the second reason, which is even more important, which often gets overlooked, when you refinance a property and take a cash out refi, the money that you're pulling out of that is not taxable.
Right.
That entire amount is not taxable.
That's exciting.
Which is incredible, which means now you can take that entire amount, right, and not pay taxes on it and now go buy another property with it.
Yep.
That's probably the most important aspect of it.
So, and let me continue with this scenario. So let's say we take a property, fix it up, go to refinance it, pull the cash out of it. Now I sell the property on a land contract, in which case the title does not transfer until the loan is paid in full. Mm-hmm. So that would extend the time that technically I am in ownership. Therefore, technically, I don't have to pay that recapture until the person who I sell or finance it to pays it off. Is that correct?
Correct.
I'm getting a little muddy in the water, I know, but
exactly. No. You're absolutely right. And this is something that's very common. A lot of people like to use this strategy, and it's important to know that the depreciation recapture and that activity does not affect the seller financing type property.
Yep. And I know that because I'm going through one of those right now. It's pretty exciting stuff. I tell you what, I've never been able to create money out of thin air, but I think I just it's been cool. Yeah. What do you think is going to happen? How does what's going on politically have to do with cost segregation, and what should somebody look out for moving forward? Let's say if we had to have an administrative change in the office.
So it's a great point because, obviously we know that real estate professionals, especially, right, and real estate in general, get tremendous tax benefits.
Yeah.
Right.
Beautiful.
It's not a new thing. Okay. The fact that there was a tax reform and there were some really great things that happened in the tax reform when Trump came into office, that was nothing really new. Meaning a lot of these things came about, even in the Reagan administration, there was big changes, big tax reform, and it's always been about that. If you look at politically, I don't think that there's going to be a huge change in terms of the real estate taxes, because it sounds like corrupt, but literally over 80% of Congress are real estate investors or own real estate, which means that obviously they're going to pass laws that are going to benefit people who own real estate, people invest in real estate. I don't think it's very likely that, anytime soon there's going to be something that's going to give way to that. Even the bonus depreciation law that came into being, the 100% bonus depreciation, that was put into play, and in the law and the reform, it said it until 2023. Until 2023, you can take this 100% bonus depreciation. In 2023, it starts to reverse itself, or not reverse itself, but becomes less. You can only take 80% bonus depreciation, and then in the next year, only 70%, and it starts to go down until, maybe in 2030, there's not going to be any bonus depreciation left. There's still depreciation, there's still cost segregation, but this extra boost, is planning, at least according to the the reform that's set now is going to phase out.
Yep. Which, I mean, by that point in time, that's a long time, right? So we got a lot of money to be made within that time frame.
Take advantage of it. Exactly.
So what about somebody that perform, let's say it's somebody that's not buying, maybe is buying a few properties a year. Would it be smart for them to do a cost segregation plan if, they're not, maybe they'll hold it forever, but they don't know? Who is the ideal candidate for cost segregation, and who is the not ideal candidate? I know we've kind of already touched on it, but is there a definition for that?
Yeah, I mean, someone who's a real estate professional, okay? And a real estate professional, according to the IRS, this is actually an IRS terminology, okay? It's thrown around, but it's actually a term that's in the Internal Revenue Code. Real estate professional, and that's someone, who works, or their spouse. And this is another crazy thing. Either you or your spouse has this status, and then you can get this tax benefit. So one of those things is, you or your spouse has to spend 50% or more of your time in real estate activity, active real estate activity, which can involve building or selling or leasing, managing property, any type of stuff, anything in the real estate business. Okay, 50% of your time. And it's not a lot of hours either. 750 hours a year, which is like 16 hours a week. It's crazy. It's nothing. You have that status. Now you can take. Listen to this. You can take depreciation deductions. You can use cost segregation and use those deductions to offset all of your income, okay, from any source whatsoever. Whereas someone who's not a real estate professional, someone who has a W-2 job, can only use depreciation deductions to offset income produced from the property. Okay, so if you're making $50,000, you have a property, you're making NOI $50,000 from it, and you have $50,000 of depreciation, that's great. You're offset, you're good. The money you made it's all in your pocket. But if you have $100,000 of deductions, because you took, bonus depreciation, you got a big extra boost, it's not going to be beneficial to you, because that $50,000 of extra depreciation, if you're not a real estate professional, will just go as what's called a passive loss. It will just go into a negative balance on your tax return and carry forward with you, but you can't utilize it this year. If you're a real estate professional, let's say you made money, doing some flipping houses, or you made, money wholesaling, you made money, brokering a deal, or your wife or your spouse is a W-2 worker and they're making $1 million as a lawyer or a doctor, right, an IT professional, and you can use all the depreciation to offset their income. So who is this best for? For anyone who's a real estate professional, one of their spouse is a real estate professional. That's who it's going to work for the most, because now you can use it and pay literally use it strategically to pay little or no income tax.
It almost seems like it should be illegal, right? It seems like it should be, right? But when I first got into real estate years ago, I looked at things like, okay, what can I get in that will never go away? And I looked around me and I was like, wow, everything I look at and everywhere I go, everything is real estate, no matter what. And somebody owns it, and somebody's making money on it, and somebody's getting the tax write-off, right? It's the most beautiful thing I've ever seen. So, I can't say enough about what cost segregation can do for you as a benefit. If you're a real estate professional. And that's funny you say real estate professional, because my CPA and I have had that conversation, or had it in the past, about, why do you keep saying real estate professional? It's like, yeah, that's an actual IRS code terminology.
Right, exactly.
Which is very cool. So where do you see yourself going, in the next 5 years, 10 years from now? I mean, do you think you're going to keep moving into this path? Are you an active investor yourself?
So I'm personally actively getting involved in that. In the past 6 months or so, because I've been interacting with people like you and my clients. I have, thank God, hundreds of thousands of clients that are utilizing this, and I'm interacting with people. I'm really seeing the real estate market and every single market in the country and every single asset class type, and I'm seeing people doing deals on a daily basis, right? Literally. So I'm able to look kind of from like a bird's eye view, and I'm like, hey, listen, This is real, right? I'm seeing it from like the actual, like a bird's eye view. And I'm seeing this as people are making a lot of money doing this. I also want to get involved. And so personally, that's actually my biggest goal right now for the next 6 months is to get involved in buying a property, either through a partnership or syndication or, you know, just doing it on my own.
Do you think that you're going to go, I mean, are you focused more in the multifamily space? Are you focused in commercial? Are you focused in residential, or do you know?
I'm focused more in the multifamily space just because the people that I want to work with.
Yeah.
I know a lot of people in every single industry, and each industry has its own niche, has its own nuances to it. But the people that I would actually want to do business with and want to joint venture with, want to partner up with, happen to be, you know, investing in multifamily. So that's kind of where I'm going.
Yep, absolutely. I can completely understand that.
It's all about people, right? I mean, that's really what this business is about.
Yeah.
It's about relationships and it's about team building, and that's incredible.
I guess let's talk about what your firm does, or how you can help people, how you can help the listeners out there. We're gonna go into this in more detail, I guess, in the lightning round. But are you across the country? Are you all over the place? What are you doing?
Yeah, we're actually one of the biggest, if not the biggest, national company doing cost segregation. We are a family of companies. Madison, we have a number of companies under one umbrella. Madison Title, we're one of the largest commercial title agents. We do 1031 exchanges. We have a company that does financial due diligence, physical due diligence on properties, environmental. But the cost segregation is we have a team of over 60 engineers and accountants and operations teams. We're doing this in all 50 states. We've done over 15,000 of these to date. And we done, last year alone, we did over 2,000. And this year we're going to surpass that as well. Almost done 2,000 already in 2019. So every single market, every asset type. Like I mentioned before, we offer a free analysis of your any property. So if you're thinking of buying a property, if you bought a property already, if you had one 5 years ago you bought and you never did cost segregation, guess what? You can actually do it retroactively and get those tax deductions that you missed retroactively. So reach out. That's the best way to do it. Reach out to get at least a free estimate. I mean, it's a no-brainer to just like look at the numbers and see if it makes sense.
Probably no catch, no gimmicks, no nothing. It's just a free estimate. You got to see what it is, and then if you want to move forward, you can, right?
Exactly.
Now, I know that this is going to change per property type, size, and everything, but what is the cost? What does it cost somebody to do a study like this? Is it hundreds of thousands of dollars? Is it $500? You know, what is it? What is an average?
So it depends, like you said, on the type of property, on the size of the property, but our fees are totally based on the scope of work that's involved. And we have kind of a structure based on the size and type of property that we work within, not taking any into account whatsoever, the tax savings whatsoever, not taking into account the purchase price whatsoever. It totally has to do with the square footage and the unit type and the type of layout. So generally it's between I'd say 80% of our work falls between $4,000 and $7,000 for a study, which is pretty competitive out there. There are definitely some that are, smaller, maybe less, but once you start getting into larger commercial properties where the scope of work is a lot more, the price is going to go up. So, but multifamily never goes above that, because the reason why multifamily has a very interesting nuance to it in the tax code, that the engineers are required to, view the entire property. But with multifamily, they're only required to see one of each unit type. So if you have, you have a 300 unit building, but you only have, 6, type layouts, the engineer only has to go into one of each of those. And then obviously the common areas as well. But that's enough. Whereas in a commercial space, like an office building, right? You have a skyscraper, you have, 300,000 square feet, and 500 suites in that office tower. The engineer has to walk every single floor, every single suite, because each one is different. So there's a lot more work involved. That's where the cost is going to get more increased.
It's just going to go up a lot, which only makes sense, right? Now, just for sake of time, we're coming up on time. Are you ready for a lightning round here?
Let's do it. Why not?
All right, let's get after it. Tell me about a time that you passed on a deal. Well, I mean, I know you're not really doing deals all the time necessarily yourself, but can you give me an example of a time that maybe you passed on a deal and why? What'd you learn out of it?
Yeah, I mean, I guess I'll go back to the time when I was a broker, just for the sake of the discussion. Passed on a deal where it actually had to do with the other broker involved, right? The buyer's broker, right? I just passed on it because the person, I could tell from the first time I met them that there was something wrong with them, that they were just wanted to, cheat me out of whatever they wanted to do. They were not straightforward. And so it all depends on the people. And I saw right through that in the beginning, and I just passed it. I don't want to do this deal. I backed out.
Sounds like you had a gut check and your gut was right, and that's something, that's a big takeaway for the listeners, is you got to listen to your gut. I think that's a really important piece. So thanks for sharing that. What's the last book that you read and what did you take away from it?
So the last book I actually finished, an audiobook, if that counts. Yeah.
Oh yeah. This is 2019, man. People don't read anymore necessarily all the time.
Right?
We're active going all the time.
Exactly. Yeah. So the last book I finished was actually Think and Grow Rich from Napoleon Hill, right? Which, it's everything that I read or I listened to, whatever in that book was completely self-evident to me, because I'm a very spiritual person and I believe very much in the power of thought and the power of mindset and the power of speech. Has a real effect on the physical world, has a real effect on, ourselves and our interactions. And so, what I took away from that, being that said, obviously that stuff is powerful, to get into your mindset. But what I took away from that is that how real it really is.
So you just happened to be speaking about my favorite book I've ever read, which is Think and Grow Rich. I've read it 3 times, and I have it on Audible. I started to listen to it just recently, but I haven't gone through it all the way. There's a lot of concepts. The craziest thing, the book that you probably listened to or read is the new version of the book, right?
Yeah, probably. Yeah, correct.
It was rewritten and using new terms because it's 2019. The text wouldn't make sense, I don't think, to the layperson today. But the power that comes into the thought that you have, I mean, you're absolutely right. Thoughts turn into actions, which turn into results. I mean, that's what you think about is what ends up happening in your life. Right. All the listeners out there, think about what you've been thinking about and look and see what's been happening in your life. Right.
You got to clear out, the garbage. It is really what you have to do.
Yep.
It's like, our minds sometimes, because the media, because of politics, because who knows what, everything we're intaking, even subliminally, is affecting how we think and what we think about. So it takes a lot of willpower to be able to kind of get in control of our thoughts and what we want to think about, and think positively, think about the things we want to think about, and not let things kind of let our mind take over ourselves, so to speak.
Yep. Amen, man. That's huge. Third thing here. Well, I know we already talked about it kind of, but what are you currently trying to learn at this point?
I'm really putting a lot of effort into learning the multifamily space. Yeah, we did speak about this, but learning, more than anything, to be honest with you, is raising money, because that's a skill. I actually have some background in that. I had a nonprofit organization that I used to, fundraise for and do, all kinds of events and do that. I traveled the world, went to 7 or 8 different countries around the world fundraising. But there's a skill set, depending on who you're speaking to and what exactly you're trying to sell or what you're trying to, raise money for. So it's different when you're raising funds for investment purposes.
Yeah, absolutely. That is such a skill. It is such a skill. It takes time to learn how to do it. So that's a good thing to learn. Maybe we'll touch base again in 6 months or a year and see how that's coming along for you.
Absolutely.
What is your superpower? If you had to say what your superpower is, what is it and how do you use it every day?
I would say my superpower is the ability to learn things at lightning speed. Like learn things very fast to be able to really be able even to teach them.
And why do you think that is? So And on that note, do you know, I'm sure you do, or have heard of him, Jim Quick?
No.
No. So he has a company called Quick Brain. His last name's KWIK. And he's
Okay.
all about learning, learning how to learn faster, right? So what do you use? How do you learn faster? How do you have that superpower?
It was never a honed skill, meaning it wasn't something that I actually worked on or took any courses on or anything like that. It's just, I think more than anything, is using your mind. Whatever you're doing. And I spent about 14 years studying very intensely, like ancient texts, like Hebrew and Aramaic, like foreign languages, like my mind thinking in at least 3 or 4 different languages, for literally 12 to 16 hours a day. So when your mind gets used to thinking that fast and thinking so complicated, in very deep and complex topics, it continues to do that as long as you're continually growing it.
Well, it's a muscle, right? So somebody that goes
Exactly.
to the gym all the time has the ability to get strong and buff or whatever because they're in the gym all the time. If you're never
Correct.
at the gym, you're not going to be that way. Same thing as what you're talking about. So
Exactly. The brain gym, as I like to call it.
and the brain gym, I like it. What about how do you give back? Now, I know that with cost segregation, you're giving back a ton to begin with, but how else do you like to give back?
So a lot of ways, really. I mean, number one, I have a nonprofit organization that I'm, still involved with, that I established about 10 years ago, and still involved with that, raising money for that, providing for needy families and people. But I give back, believe it or not. I love to give in the form of helping other people, meet other people, like make the right connections. So because I know a lot of people, and maybe it's connected to the fact that my mind kind of thinks fast, right? I connect people to one to another, make introductions all the time, trying to help advance other people's businesses.
I love it, man. That is huge. Those connections you make for people can be the game changer for them.
Totally.
I mean, absolutely. Well, that leads me into my last question, Yonah, and that is how can the listeners reach you? I know that there's going to be people reaching out about cost segregation, about how they can get involved with you. Where can they find you?
The best place to find me is on LinkedIn. Actually, I'm extremely active there. I actually just gave a webinar a couple days ago on Labor Day about how to utilize LinkedIn, and we had over 100 people sign up for that. And I'm extremely active there. It's a great community, a great social media platform. Find me there. Bigger Pockets, I'm also very active on. You can use my email, maybe put it in the show notes, my phone number, 732-298-9002. Call anytime. And check me out.
Well, hey, man, we will make sure to put that in the show notes here for the listeners out there to be able to reach you. And for all the listeners that are getting some value out of this podcast, and you heard something you're going to put into your life and invest in your life or business, please like this, share it, subscribe to the podcast. We're on a mission here to invest this and try to affect people's lives in a great way. So with that being said, Yonah, thanks for being here, man. You shared a ton.
Okay, awesome, Scott. Thank you. I appreciate it.
Absolutely. And we'll make sure to stay in touch and see where we're going to go from here.
Okay, awesome. Sounds good.
All right, man. Talk to you soon.
Thanks.